Have you ever seen this? A screen full of flashing numbers, jagged lines shooting up and down, and people yelling about things like PE ratios, bull markets, and quantitative easing? It's designed to look complex, important, and honestly a little terrifying. For many, the stock market feels like a secret club you weren't invited to, speaking a language you don't understand. If you've ever looked at all this and felt completely lost, overwhelmed, or even anxious, you are not alone. That feeling is what stops most people from ever getting started. But what if we told you it's all much simpler than it looks? What if we could explain how it all works? Not with confusing charts, but with something we all understand. Forget the tickers for a minute. We're going to take you somewhere else, to a giant, bustling marketplace, a place filled with stalls, shoppers, and vendors. Because once you understand the simple rules of this market, the stock market will suddenly make sense. This market has rules, and in the next 15 minutes, we're going to teach you the most important ones. So if you're ready to finally understand how it all works, make sure you're subscribed to Gen Shift, and let's go to the market. 1. A giant marketplace. What are stocks and why do prices move? Welcome to the market. It might not look like Wall Street, but this is the clearest way to understand what the stock market is. Every single one of these stalls represents a real company, and a stock is nothing more than a tiny fractional piece of ownership in one of these stalls. That's it. When you buy a stock or a share, you are buying a certificate that says you own a small slice of that company. You now have a claim on a fraction of its assets, the buildings, the equipment, and more importantly, a fraction of its future profits. Now look at the signs above each stall. You'll see a price. But that price isn't set by some mysterious force. It's determined by the people in this marketplace, the buyers and the sellers, in a constant real-time auction. This is driven by the most fundamental law in all of economics, supply and demand. Let's see it in action. Imagine this company just announced a revolutionary new product. The news spreads like wildfire through the marketplace. Suddenly, everyone wants to own a piece of this stall. This creates high demand. Dozens of shoppers are trying to buy, but only a few owners are willing to sell their valuable pieces. What happens? The buyers have to compete. One shopper shouts, "I'll pay $150. Another yells, "I'll pay $155. To convince someone to sell, the price gets bid up. When more people want to buy a stock than sell it, when demand outstrips supply, the price rises. Now, let's look at the opposite. This stall over here just got some bad news. Maybe their latest earnings report was disappointing, or a key leader just quit. Shoppers hear the news and lose confidence. They start walking away. Now, the owners who want to sell are in a tough spot. There are very few buyers left. To make a sale, they have to lower their asking price. Will anyone take this for $50? One asks. Silence. $45? When more people want to sell a stock than buy it, when supply is greater than demand, the price falls. This is happening millions of times a second for thousands of companies. The price you see on the news is simply the price of the very last transaction between a buyer and a seller. So what causes these crowds of buyers and sellers to form or disappear? It's all about information and emotion. The most important factor is the company's performance, its earnings. When a company consistently makes a lot of profit, it's like a stall that's famous for selling high-quality goods. More people will want to own a piece of it. But other things matter too. Broader economic news, like changes in interest rates or inflation, affects the whole marketplace by giving all the shoppers more or less money to spend. And then there's investor sentiment, the overall mood of the market. This can be influenced by major world events, industry trends, and even hype or fear spreading on social media, which can create huge swings in demand based on emotion rather than facts. At its core, a stock's price isn't just a random number. It's a real-time, data-driven measure of the entire world's collective belief about a company's future value. It's the story of human confidence told in the language of money. 2. Investing versus trading. Who should play this game? So now that you're in this marketplace and you understand the basic rules of how prices are set, you have a choice to make. How do you want to participate in this game? Broadly speaking, there are two main approaches, two types of players you can be, and the difference between them isn't just about strategy, it's about psychology. First, there's the investor. Think of the investor as a long-term farmer. A farmer doesn't buy a plot of land to sell it tomorrow. They do their research, they look for good soil, a fundamentally strong company with solid earnings and a competitive advantage. They look for a great location, an industry with long-term growth potential. Once they buy their plot or their stock, they hold it. They nurture it for years, even decades, trusting that over time, the value of their holding will grow substantially. This approach is defined by patience, research, and a long-term vision. The farmer isn't bothered by the daily crowds or the short-term price swings. Their eyes are on a harvest that's years away. Then there's the trader. Think of the trader as a day vendor at the market. The vendor isn't trying to grow anything. They buy a crate of apples in the morning, hoping to sell them for a few cents more per apple by the afternoon. They are trying to profit from tiny, rapid price fluctuations. This is an incredibly demanding, high-stress, full-time job. It requires constant market monitoring, deep technical skill, and a huge appetite for risk, because a small shift in price can wipe out their profits for the day. The biggest difference between the farmer and the vendor is the psychological battleground they operate. Short-term trading is a minefield of behavioral biases. It exposes you to two of the most powerful and destructive emotions in finance: fear and greed. When you see a stock skyrocketing, the fear of missing out, or FOMO, can trigger a powerful herd mentality. You buy simply because everyone else is, without doing your research. Conversely, when the market dips, the intense fear of loss can cause you to panic sell, locking in your losses at the worst possible time. Research shows the pain of a loss feels about twice as powerful as the pleasure from an equivalent gain, a bias called loss aversion, which makes panic selling a very common and costly mistake. The long-term investor strategy, on the other hand, is specifically designed to defend against these emotional traps. By focusing on a time horizon of years, not minutes, the investor smooths out the daily noise. Their success depends on cultivating psychological resilience, the discipline to stick to their plan, and the patience to ride out the inevitable market storms, trusting in the quality of the land they've chosen. So you have to ask yourself a fundamental question. Do you want the patient, methodical work of a farmer, building wealth over a lifetime, or the high-stress, high-risk, full-time job of a day vendor? For nearly every single person starting, the answer is clear. You want to be a farmer. 3. The secret rule, the power of compounding. Now we come to the final and most important rule of the game. This is the secret weapon that long-term investors have on their side. It's a force so powerful that Albert Einstein supposedly called it the eighth wonder of the world. It's called compound interest. And it's simpler than it sounds. Compound interest is the interest you earn on your interest. It's your money making money, and then that new money is making even more money. The best way to visualize it is with this snowball. Your initial investment is this small snowball at the top of a very, very long hill. The first year, your investment earns a return, and the snowball rolls over once, picking up a little more snow. It's slightly bigger. The next year, it rolls again, but now it's earning a return on the original snow and the new snow it picked up. With each turn, it picks up more snow and moves a little faster. Over decades, that tiny snowball can grow into a massive, unstoppable avalanche of wealth. That is the power of compounding. This isn't just a nice theory. It's proven by nearly a century of data. This chart shows the performance of the S&P 500, a collection of 500 of the largest companies in the U.S., over the last 50 years. As you can see, the long-term direction is unmistakably up. But look closer. It's not a smooth ride. There are terrifying drops along the way. These are the moments when fear takes over the marketplace, when panic selling is rampant. And this is where most people lose. But now watch what happens when we zoom back out. Every single crash was eventually followed by a recovery, and then new all-time highs. The secret to winning the game isn't trying to predict or avoid the dips. The secret is having the discipline to stay in the game and let the power of compounding do its work over long periods. And for you as a young person, time is the most powerful asset you will ever have. Let's imagine two investors. Sarah starts investing $5,000 a year at age 25. She stops completely after 10 years at age 35. Ben starts later. He invests the same $5,000 a year, but he starts at age 35 and invests every single year until he's 65. Who do you think ends up with more? Even though Ben invested 3 times as much money out of his pocket, Sarah ended up with hundreds of thousands of dollars more. Why? Because her money had an extra 10 years for the snowball to grow. That is the magic of starting early. Conclusion. So, the stock market isn't a secret club or an unpredictable casino. It's a giant marketplace with rules, and now you know them. You know that a stock is a piece of a business. You know that prices are driven by the human emotions of supply and demand. You know the crucial difference between being a patient farmer and a frantic vendor. And most importantly, you know about your secret weapon, the incredible power of time and compounding. The complexity is designed to keep you out, but the fundamentals are designed for you to win, as long as you have a long-term plan. The most important thing you can do is start. Start early, start small, and stay in the game. Your future self will thank you for it. We want to hear from you. What's the biggest question you still have about starting your investment journey? Let us know in the comments below. And for more guides to help you build your financial blueprint, make sure to subscribe to Gen Shift.